Hello everyone and welcome to our podcast on Market Ki Baatein. Well, the Q3 result season is behind us, but yes, it has left us behind with some bad memories, and we are trying to understand how really are we going to deal with them and whether are we going to make some money. Well, that's what is our end motto. If you look at what is the kind of structure or the kind of statistics which are ahead of us, you see that around 32% of the stocks have actually closed positive, while 45 were neutral and 23 were negative. Despite 45% of the stocks being neutral, it really had some impact. There were governance issues, along with some kind of trade war issues with the US and China. So all these global impacts plus the rupee not giving us room for breathing, all this has impacted the way we are looking at the markets, and the volatility which we are seeing here is something quite different. And amidst all this scenario, we need to see how we are going to handle the Q4 season, which is already underway. So for this, I have with me the fund manager of Plus Delta Portfolio. It's a portfolio service which we have launched, and the fund manager is Aditya Iyer, who is with me here, and he is going to give us some idea about what is the kind of outlook we can maintain after Q3 result season. Aditya, over to you. We'd like to hear from you as to what is the kind of outlook which we can maintain.
So, hi, Raja. I would first like to recap what we saw in Q3 FY19. I think the Q3 results, as you said very rightly, was a mixed bag. Overall, some sectors surprised on the upside, but yes, as you mentioned, we also saw a lot of negative surprises. The consumption theme did well, and most companies in the consumption pack posted strong revenue and volume growth. But overall, I think margins was an issue for many companies in Q3, and many companies posted margins, EBITDA and PAT margins that were below the market's expectations. Now, I think for most companies, the underperformance on the margin front was mainly due to lower than expected RM benefits arising from softening crude prices. So if you analyze the auto companies, they saw a margin contraction on the EBITDA side of approximately 2%, which is really large. And apart from auto companies, we also saw poor profitability from the energy and telecom stocks as well, which led to an overall decline in the profitability of the NIFTY. So this is exactly why the NIFTY posted a revenue growth of upwards of 20%, but the EBITDA growth was only 5%, and this 5% EBITDA growth is actually a 6-quarter low. So yes, the winners in this result season were definitely there, like consumer-oriented companies, financials, cement, select industrials, but auto, telecom, and energy were the laggards.
True, it's definitely a mixed bag, and amongst them, I feel also on the technical front, the consumer-oriented companies have really done well, and I would feel that if one is tending to look at consumer-oriented space, they should be looking at stocks like Jubilant Food, which is looking good on the charts, along with Baatein, which continues to hold its fort at higher levels. And the surprising sector is the cement one, actually, Aditya. I find that they, after witnessing strong declines over the last few months, they have been witnessing a turnaround. And from there, I would pick on Grasim. So they are my picks from the sectors which you have highlighted, and it definitely looks interesting. So now, if you are going to look at what is the kind of situation and what kind of outlook we need to maintain. So what are the valuations speaking then?
So, before getting into the valuations, one interesting fact that I would like to highlight is that the pace of downgrades, like earnings downgrades, that we've witnessed in this quarter has definitely slowed down. So what this exactly means is that now there are lesser number of stocks that are being downgraded by market analysts compared to earlier quarters.
That's interesting.
So if you analyze the Bloomberg consensus data of the NIFTY 50 companies and the BSE 100 companies, you will find that 20 companies have actually given a positive earnings surprise in Q3 compared to just 11 in Q2 and 17 in the third quarter of last year.
So let me ask you this: how are you going to then handle it? How do you handle this in your portfolio management, which you are doing right now? So, do you have some kind of model in play, or how do you go about doing that? Of course, I do know that you had discussed with me earlier also that portfolio management is handled by Dr. C.K. Narayan, who is using a proprietary CGM model. So over the last many years, you have been doing this, and what kind is your approach? Can you just
Yeah. So the portfolio management service is being handled and being managed as per our proprietary CGM model, which is a combination of growth and momentum. So Dr. C.K. Narayan is the CIO of our fund. I manage the funds and the portfolio. We have both technical and fundamental analysts working around the clock and trying to identify stocks in this decline.
So is your model only based on fundamentals, or how is it?
So it is actually a combination of both fundamentals and technicals. It's a long-term trend following model where we fundamentally vet stocks and with strong balance sheets, cash flows, and that display earnings growth. We combine that with our proprietary technical indicators for trend following and for those to recognize momentum.
Oh, that's really very interesting. I'm sure that you'll be able to catch the stocks at the right moment. And looking at the way the Q3 has panned out, do you think the way the P ratios would be playing out, do you have any take on them?
One thing we must remember is that for the past 2 years, what has really been driving the growth in stocks is P re-rating. So in the beginning of FY18, we saw a substantial P expansion taking place, and P expansion was rampant across most large cap stocks. In the beginning of FY19, we saw some initial signs of P derating emerging, which was accentuated in the last 2 quarters of FY19. Now we see the pace of derating slowing down, and I think that some bit of normalization is coming back to the markets, and peak pessimism that was built up is easing off. At least in the large caps, it's easing off.
Okay, so in a nutshell, you would say that we are looking at some positive turnaround in certain companies?
Yes, of course.
Okay, that's nice to hear, because that's what our viewers and our listeners want to hear about it in this podcast. So if I were to, actually say the sector which is producing a turnaround, so which sector would you highlight?
I think after looking at this quarter's results, it is definitely the return of the corporate banks. So when we started Q3, we saw a lot of concerns around liquidity in the banking system, the ILFS issues, some worries over NPA recognition, etc. But I think banks have progressed over all these problems really well in this quarter. Private banks especially have given a good all-round performance where their margins have increased and their revenues have increased, and the reported stressed assets have also reduced, indicating that a large part of the corporate stress has already been recognized in the system. The PSU banks have also reported lower slippages, and one of the Biggest elements I think was that ICICI Bank and Axis Bank have reported lower slippages this quarter.
Yeah, I agree with you, Aditya. Yes, the news flow for ICICI and Axis definitely seems to be in the positive way. But looking at the charts, I feel that the ICICI was more deep in the negative news flow, and the pullback in ICICI definitely looks positive, and one should look to initiate some positions in ICICI rather than Axis. So that's our take on the Q3 result season. Some views on the P, some views on the sectors as well. So thank you, Aditya, for this interesting discussion on this podcast. We'll be coming out with more podcasts where we'll share our views and analysis on stocks, on the markets, and more such interesting stuff. So stay tuned, and thank you for listening.
Thank you, Raja, and thanks to all of our viewers for tuning in. Goodbye.
Thank you. Goodbye.